This week, Microsoft made stock market history on Wednesday, and Amazon beat that record by Friday. Good morning. It's Saturday, August 1st. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. Normally, this is a coffee and preview show. Today, it's coffee and a report card. This is the week, graded. 5 sessions, one Fed that split 3 ways for the first time in a decade, a hyperscaler earnings gauntlet that divided the market clean in half, a chip sector that cracked and then uncracked itself, and a war scare that flared twice before the week was out. We're going to replay it, grade it, and own what we got wrong.
Morning, Nick.
Morning. Grading week. I like our odds today, actually.
We'll see. First, the board, because yesterday's show left us 3 checkable calls, and only one of them is actually checkable this morning.
Mine is. I said if either Exxon or Chevron trimmed full-year capex guidance even slightly despite the size of their beats, that's the tell that management doesn't trust $87 oil to hold. Neither one trimmed. Exxon held its range at $27 to $29 billion. Chevron held 18 to 19. I'm marking that a loss.
You're not going to soften that at all?
A little. Chevron said on the call it expects to land at the low end of that range, which is at least a whisper of the caution I was betting on. But will land low in the range we already gave you isn't a trim, and I said trim. I lose that one on the letter of it.
Appreciate you not dressing it up. Small mercies.
Marcus, your tariff call, and Sarah's oil call note resolved today. Marcus, yours needs 30 days to see if any of the 60 countries get an exemption, and Sarah's Brent number is a next Friday call. Both sit as pending, not scored.
Fine by me. Less time in the loss column this week.
Scoreboard then. Eleanor moves to 9 wins, 6 losses, and that snaps her streak, resets to -1. Marcus, 7 and 9, streak stays +2 since nothing new landed for you. Sarah's 0 and 1, Dave's 0 and 2, both still waiting on their next number. All right, that's the ledger. Let's grade the week that produced it.
Where do you want to start? Because there's an obvious answer and a less obvious one.
Obvious one first. The AI spending verdict, because 4 different companies answered the same question 4 different ways this week, and it's a story that's been building for 2 weeks running.
Let's do it chronologically because the order actually matters. 2 weeks ago, Tesla and Alphabet both beat revenue and both got hammered. Tesla down 14%. Alphabet down 7% after raising its capex guide and posting negative free cash flow for the first time since its own IPO. That set the test. Spending on I stopped being an automatic pass.
And this week, 4 more companies took that test. Wednesday night, Meta and Microsoft, minutes apart. Microsoft's the cleaner story. Azure grew 43% constant currency, crossed $100 billion in annual revenue for the first time ever, and the stock ripped over 15%, one of the largest single-day gains in market history for a company that size. Meta missed on earnings, guided the current quarter light, raised its own capex floor to $130 billion, and fell about 8%.
Same night, same theme, opposite verdicts, and I called both of those the day before they happened, for the record. Then Thursday night, Amazon. AWS did 37%, fastest cloud growth since 2021. First ever $200 billion quarter, and the stock jumped as much as 15% and held it into Friday's close. I said Wednesday before any of that printed that if ASM cleared 31% and the stock held up despite a bigger capex guide, that's a 3rd hyperscaler in a row proving the market rewards spending that's already converting to cash. That's exactly what happened.
That's a clean call 3 days running on 3 different companies. I'm calling that our call of the week.
I'll take it. Feels good to have the record catch up to the argument, even a little.
It's a deserved one. You were out ahead of that thesis from Monday, and you didn't move off it once the whole week. I'll add the piece that's mine, though, because it's not just spend and get rewarded. Apple reported the same night as Amazon and told the opposite story, beat on revenue, iPhone sales up 22%, and the stock still fell 9% into Friday's close, its worst post-earnings reaction in years, because services in China missed and the guide came in soft on a memory chip supply crunch.
Walk me through that mechanism again, because it's the one thing this week that isn't obvious on its face. How does a memory chip shortage hit Apple specifically?
Apple doesn't make its own memory, it buys it, same as everyone building phones and servers. If the AI build-out is soaking up global chip supply, and Microsoft and Amazon just told you they're spending more to lock down exactly that, the input costs for anyone downstream go up and availability gets tighter. Apple's now competing with its own cloud computing customers for the same chips.
Which is genuinely the most interesting sentence of the week, if you ask me. This stopped being an abstract capex versus revenue argument on a spreadsheet. It's showing up in whether Apple can actually get the parts it needs for the next iPhone cycle.
So 4 companies, 4 verdicts. Microsoft rewarded, Amazon rewarded, Meta punished, Apple punished for a completely different reason. What's the one sentence that ties all 4 together for somebody who only caught headlines this week?
If your growth is contracted and already converting to revenue, you got paid, same as Microsoft and Amazon. If it's a promise about next quarter, or it's a supply problem you can't spend your way out of by Tuesday, you got picked apart, no matter how good the trailing number looked.
Good line. Let's move to the story underneath that one, because the Fed didn't wait for earnings season to make its own case this week.
No, it did not. Wednesday, 2 o'clock, the Fed held its rate steady at 3.5 to 3.75%, completely as expected. What wasn't expected was 3 policymakers dissenting in favor of a hike instead: Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan. First 3-way hawkish split on this committee since September of 2016.
And Kashkari specifically mattered, because he's not usually the hawk in the room.
That's exactly why it landed the way it did. When someone who spent most of this cycle looking past noisy data suddenly votes to hike, that tells you the underlying data moved him, not that he's just following a faction. And the market's reaction proved it wasn't a footnote. Stocks actually rallied on the hold itself, right out of the 2 o'clock decision, then gave it all back and more once Chair Wash's press conference got going. By the close, the Dow was down 1,153 points, worst single day since April of last year.
That's a strange one to explain to somebody who just wants to know if their mortgage moved. A rate that didn't change hit the market harder than a hike everyone saw coming.
Because the 10-year and 30-year yields did the moving instead. 30-year hit its highest level since 2007, above 5.2%, and by Friday the 10-year was above 4.7, its highest since January of last year. When a hold gets read as falling behind instead of steady, it's the long end of the curve repricing, and that's what actually sets mortgages and corporate borrowing costs, not the number the Fed itself moves.
Let me push on this a little, because it's easy to say hawkish Fed, yields up, bad week, and move on. Is there a version where this doesn't matter as much as Wednesday made it feel?
Sure, and I'll make that case because somebody should. Inflation's still running above target, so 3 hawkish votes isn't crazy, it's arguably overdue. This isn't the Fed suddenly discovering a problem that wasn't there, and Warsh still held the line at the podium. He didn't hike. The base case for September didn't actually move as much as the one-day chart makes it look.
I'd still push back. Once a committee shows you it has a real hawkish block, every future data print gets read through that lens. A hot inflation number in August doesn't face one lonely dissent anymore, it faces 3 votes ready to act on it. That's not the same distribution of risk it was on Tuesday.
All right, one gut check before we move off it. Small caps got hit hardest of anyone Wednesday. The Russell down more than any major index that day, but it's also true that same index has quietly been having its best year since 1991, up more than 20% year to date even after this week's wobble. Which one of those is the real story?
Both, honestly, and that's not a dodge. Small caps carry more floating rate debt, so a hawkish surprise hits them first and hardest. Same day the broader tape wobbles, but the year-to-date number hasn't gone anywhere. It's a rotation that's real money, not just a talking point, getting a stress test in the middle of a violent week. And it passed the test in the sense that the money didn't leave, it just got nervous for an afternoon.
Quick pause before the next one. I have to ask because it's been a running bit all week. Eleanor, structured caffeine intake, week 3. How's the weekend treating the program?
The program does not recognize weekends, Nick. That's the whole point of structured.
The most on-brand answer possible.
Fair enough. Back to it. Chips. Because of the Fed and the earnings split with the loud stories this week, this was the one that actually moved the fastest.
And this is where I want to grade myself honestly because I had a call running for 3 straight days and it broke. Monday and Tuesday, a Chinese state-backed memory chip maker called CXMT debuted in Shanghai and surged as much as 465% on day one, an $8.5 billion raise, briefly a market cap near $475 billion on paper. The whole memory complex sold off in sympathy within hours. Micron, SanDisk, Samsung, SK Hynix all down hard, and Korea's Kospi fell more than 10% Tuesday, tripped a circuit breaker.
And your call was?
That the route was spreading, not rotating, and my own test was needing to see the semiconductor ETF, SMH, extend its slide into a 5th or 6th straight red day. I said Wednesday I'd concede the moment we got one green close. We got 2 Thursday and Friday, chips ripped. Intel up 11%, the whole complex riding Microsoft's Azure number higher. By my own rule, that's a loss, clean, and I'm not going to pretend it isn't.
I'll give her credit. She said the rule out loud before she knew the answer, which is the only way any of these calls mean anything.
What's the honest version of what actually happened there, now that the whole week's in front of us?
It's not that I was reading the tape wrong on Tuesday. SK Hynix posted a record quarter and still got sold 13–14% that same day, which really did look like a market that had stopped paying for merely spectacular. What I missed is that the shortage underneath it is a physical fact, not just sentiment, and once the panic settled, the actual scarcity reasserted itself fast. SMH is still down about 9.5% over the past month, worst month for that ETF since 2002, even after 2 green days. So I'm wrong on the letter of my own call, and I still think the spirit of it, that this was a genuinely fragile month, isn't fully wrong either.
I'm calling that our miss of the week, not because the read was careless, but because you set a specific breakable rule and it broke.
That's fair. That's the deal.
And I'll take the other side of it properly, because I've been saying it since Wednesday. Micron's up more than 12% the same week Samsung and SK Hynix were crashing, on $100 billion in binding, multi-year contracted demand for the high-bandwidth chips that actually feed AI processors. That's not a story cracking. That's a story where contract visibility, not exposure to the theme, is what the market's actually paying for right now.
Give me the piece that ties chips back to big tech's capex fight, because I don't think listeners should hear these as 2 separate stories.
They're the same story, upstream. Every one of those hyperscaler capex numbers we just spent 10 minutes on, Microsoft's $255 to $260 billion, Amazon's raise to roughly $220, that money buys the exact chips that just went through a week of chaos in Shanghai and Seoul. The demand side of this story never wavered. It was the supply side and the financing fragility questions around it that had a bad week.
Last thread, and it's the one that touches almost everything else we said: oil, Iran, and the tariff wave that landed Friday morning.
This one had real whiplash. A week ago Friday, Brent was pushing toward $100 on an unresolved Iran conflict. Over the weekend, the US and Iran paused fighting, and Monday morning, oil fell nearly 7% on the news. Then Tuesday night into Wednesday, Iran hit back with what's being described as an attempted strike, oil spiked again, and by Thursday, after the US actually struck back, Brent was back above 92.
And then it eased again by Friday. WTI down about 1.5%, Brent under 88, because tanker traffic through the Strait of Hormuz had recovered to something like 30 to 35% of pre-war levels. Still depressed, but moving the right direction, and that's a more honest signal than any statement out of either capital.
So a ceasefire, a strike, a counterstrike, and a partial recovery, all inside one trading week. And then, Friday morning, you added a tariff wave on top of it.
60 trading partners, the European Union, China, the UK, Canada among them, 10 to 12.5%, effective at midnight Friday. My worry is straightforward. That's a direct input cost shock landing on the same inflation data a newly 3-way hawkish Fed is already parsing. Watch core inflation over the next 2 prints. If tariff-exposed goods categories start accelerating in August and September, that hands the Fed's hawks more ammunition right when they've already got 3 votes in the room.
And I still read it differently, and I want to be clear, we did not resolve this yesterday, and we're not going to resolve it today either. Futures were green Friday morning with all 60 tariffs already on the board. That's at least partly the market pricing this is an opening offer. The same pattern we've seen with prior tariff waves, where chunks get rolled back or exempted inside weeks.
And my pushback stands too. Tariff inflation shows up with a lag, in data a month or two out, not in Friday's open. Calm futures the same morning aren't a clean verdict on trade policy.
So that's genuinely still split, and I'm going to leave it there rather than force it, same as yesterday. Eleanor is watching core inflation over 6 to 8 weeks. Marcus is watching whether any of the 60 partners get an exemption inside 30 days, which, worth remembering, is also his still pending call from yesterday's board. Same clock, 2 ways to read it. We'll know more by the time either of those windows closes than we know this morning. All right, the week in one breath. A Fed that split 3 ways for the first time in a decade and sent long-end yields to their highest since 2007. 4 hyperscalers, 2 verdicts. Microsoft and Amazon rewarded for spending that's already converting. Meta and Apple punished for a promise and a supply squeeze. A chip sector that cracked across 3 countries in 2 days and then mostly healed in 2 more. And a war scare that flared, cooled, flared again, and closed out the week under a brand new 60-country tariff list. Marcus's Amazon call was the cleanest red of the week. Eleanor's chip call was the one that didn't survive contact with Thursday and Friday, and she said so herself. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and catch our live takes all day at Nova Ventures CEO on X tomorrow. We'll look ahead to the week that's coming. For today, that's your Saturday wrap. Have a great rest of your weekend, and we'll see you tomorrow.